Okay, everybody, it is high noon and we're going to start our broker chat session today. Thank you all for joining me. I'm Tom Fulkerson. I'm the qualifying broker for the Keller Williams Heart of Atlanta Group. And I appreciate you guys joining us today. This is a topic we're going to discuss today that I'm starting to get a lot of broker calls about, and mainly about seller financing, because with interest rates where they are today, sometimes we have to get a little creative with our sales strategies. And this is something that we went through, back in 2008, 2009 to get homes sold. So we haven't had to deal with this in a very, very long time. So this session for you guys is really informational. Because I need you to start thinking about creative ways to get people into a property. And we're lucky today to be joined by Krishen Shah with Highland Mortgage. Hey, Krishen.
Hey, Tom, how are you guys? Thank you so much for having me on. I really appreciate it. Looking forward to it.
Good. Krishen has been his background was with the processor for one of the top loan officers in the Atlanta market, and now he is a loan officer with Highland. He's very knowledgeable about different strategies to get people in homes creatively, a little bit outside the norm, perhaps. And so feel free to ask questions. This is all kind of new territory for all of us. We haven't had to do any kind of seller financing in a very, very long time, or really kind of think outside the box. So I really wanted to spend a little time today talking about that so you all could dig deeper into it and be well-informed to be able to answer questions and maybe guide your clients through what might be a tough process. So Krishen, I'm gonna ask you what type of financing have you seen that's outside the normal realm of conventional FHA and VA? I know personally I've had agents call me about seller financing, and there is a GAR form for seller financing. It's relatively simple, and we'll talk a little bit about that while we're on this call today. But I'm going to turn this over to you, and then I'll ask you questions and maybe get you going, and you can help these agents understand options that may be available to them that they may not be aware of.
Yeah, no, happy to, and thank you again. I would say I've done a number of different type of programs this year. It kind of started out with just being able to separate ourselves from how fast we could get clients approved, how quickly we could get appraisals back, all of which still definitely help. If you are the likelihood is if you really love a home, there's probably some other people that really love that home as well. So I think being able to set our clients up to close very quickly, get appraisals back very fast, and get you approved through underwriting as little as a couple of days, or already be approved prior to going under contract, is definitely a way to kind of creatively win a deal. A couple of the things that I have utilized outside of the norm, which is kind of like what you said, conventional FHA VA, is bank statement programs for self-employed clients, the investor loans like DSCR. I actually have an asset qualifier program going on right now, which essentially is really good for people who have a whole bunch of retirement income, maybe 401k income, just a lot of assets to their name. And it's actually a product where maybe you don't qualify very well with the income that's coming in. Maybe you're just choosing to only take in Social Security right now, maybe only taking a little bit of 401k or distribution from an IRA account. But what we do that product is what we can take in the overall amount of assets that you hold to your name, 401k, IRA, checking savings, mutual funds, stocks, and we essentially there's a little bit of an algorithm that kind of comes from that, and we take the overall assets, divide it by essentially 3 years, and come up with a figure to come up with your overall income. So that is a good way if you ever kind of come down to it. And then bridge loans are another big one, where if you are looking to put down a big down payment, but you have your current home kind of maybe holding you back, so to speak. A couple of different ways is definitely doing a bridge loan, maybe even a cash out refinance if it makes sense. The bridge loan again is a product that is good for you to only have as it's a very temporary thing. It's an interest only payment, which is great. The hope is that you're only maximizing maybe 1 or 2 months of having a double mortgage payment there. Again, the bridge loan is only an interest only payment, so that kind of helps in terms of limiting how much output you're putting towards those mortgages for the first couple of months until you're able to sell that current home. And then lastly is going to be the one, and probably the most important one that's going on right now, is the step up kind of buy. We call it a step up program. It's a buy down program, kind of like what you're saying. It's a seller finance to help get your interest rate a lot lower. This is a product that I have kind of really put forth into agents and clients' minds right now, as the market has shifted completely into a little bit more of a buyer's power. Listings, and you guys can obviously correct me if I'm wrong, if listings are kind of, they're hanging around a little bit longer than we were kind of used to seeing there due to the earlier parts of the year. And a good issue is, and I kind of can put an example out there for you as well, is I had a client that was purchasing a $550,000 house, and they were just not dead set on their rate. Their rates, they're talking about 7.5% right now. And I was able to kind of put it in the client's ears and the agent's ear that, hey, this could be a good potential scenario for the buy down program. And what you want to really do is put it into the agent's ear first. That way, when I go to the client, the agent is aware that I'm putting this product into the client's ear, and that way the agent can be prepared, or I can have those talks with not only the selling agent, but the listing agent as well. Kind of long story short here, but the cost of the program has to be paid for by the seller. It cannot be paid for by the buyer. Not a single penny can be contributed to by the buyer. So what we were able to do, and this is kind of one of the happier, more successful stories that I have, is that we were able to essentially, let's just say hypothetically, the cost of the program, for mathematical purposes, the cost of the program was $10,000. We were able to bump up the purchase price for the home from $550 to $560, but in turn, the buyers asked for $10,000 in seller pay closing costs. Now, in this aspect, you do want to watch your limits there. Fortunately for them, they were at a 6% limit, so they were well below the cap there. Hypothetically, if they were only putting down 5%, they're at a 3% max. You're still fine, but you want to kind of watch that. And so we were able to get them under contract for $560, $10,000 in seller pay closing costs, and we did what is called a 2-1 buy down. And essentially, from months 1 through 12, the first entire year, their interest rate was when rates were right about 6.5. So their interest rate was at 4.5% for the first year. And then months 13 through 24, the entirety of the second year, it was at 5.5, 1 percentage point lower. So the 2-1 is 2 percentage points lower for the first year. Second year, an entire percentage point lower. And so that's kind of, so they were very happy with that. They wouldn't reach their full 6.5 interest rate, final kind of end interest rate there until they're not going to reach it until mid to late 2024, which hopefully the idea is that they'll be able to refinance out of that well before they reach that cap. So the buyers are happy, the sellers are happy because they netted the same amount of proceeds. The agents were happy to get this thing closed. So a really, really kind of good scenario there. It just takes a little bit of everyone understanding how the product works, and once you kind of nail that down, it's a pretty cool scenario.
Let me interrupt you there for a second, because I've
Yep.
heard several lenders in team meetings outside of Highland Mortgage talk about this program. I think you guys on the call, this is a very, very important strategy for you to understand. So I want to make sure that you guys are clear about how this program works for the buyer. They get a discounted rate on their interest rate for the first year. The second year, it goes up some, right?
That's correct. Yeah. So the first year, I apologize. There's multiple different programs. This particular one, I did a 2-1 buy down. So the first year, the interest rate was 2 percentage points lower than what the note rate, the market rate was. So it went from 6.5 to 4.5. The second year went up to 5.5, but still significantly lower than what their actual payment would have been if they had just went with a 30-year conforming conventional fixed mortgage type of thing. So save them. I think off the top of my head, I saved them close to about 11 grand in total for those months combined in their monthly payments.
How does that differ than like a 7-year adjustable rate, for example? Is that still a better way to go for our agents?
Yeah, no, great question. So the ARM programs were really, really sought after there for a good 3 to 4 months, and they're still a good program. Your interest rate's still going to be a little bit lower. Kind of what I'm seeing right now is, let's just say we're at 7.5% right now for a par rate. A par rate means you're not buying down any points, you're not paying any discount. And what I'm seeing right now is if you're at 7.5% for a 30-year fix, for a 7-year ARM, you might be an eighth, or if you're lucky, 1/4% lower. So you're talking about at the most 7.25. And the way an ARM mortgage works is it's still a 30-year mortgage, but it's amortized over 360 months, but it's only discounted for the 7-year period. And then on the starting of the 8th year, so the 85th month, you would go to where the market rate is. And again, the idea with ARM, especially in this market, is you're going to refinance before you ever get to it. But to answer your question, it's much better, I believe, to do a buy down program, just because all signs are pointing to us being, we are in a recession by every stretch of the definition, but the idea is that well before you hit that beginning of that 3rd year, to maybe towards the middle to the end of the 2nd year, you're going to be able to refinance to a much lower rate, and while saving thousands, maybe even tens of thousands of dollars, if depending on your price point, during the first 2 years.
Guys, I love this program. I think it's a smart program for buyers. It's a lot better for both parties than seller financing. Seller financing is generally going to happen when the buyer has significant amount of cash, but they don't want to pay a 7% rate. Okay. And unless a seller has a property that's less desirable, this is a much better way to go, because once you get them in a property, if they decide not to close on it, then and especially if they decide not to move, then you've got to go through the dispossessory process. But this is very clean and straightforward. And again, I want you all to understand how this program works, because it saved these buyers about, in his example, about $11,000 the first year in interest. And that's significant. And I think we as professionals need to understand these programs, because the biggest hesitation right now, particularly with first-time home buyers, is that, they're freaked out and scared about the rate. They're not married to that rate. Okay. They're not married to it. But if we can get the seller to contribute the closing costs that are needed to do this buy down rate, then it's a win-win for everybody. So I want to make sure everybody understands this program and can, sell it to your clients moving forward.
Yeah,
Any
and then
questions
there's
about it?
I'm sorry.
Go ahead, Krishen.
No, and then there is actually one other program that I wanted to relay over that's been pretty huge for me. And I've actually done this presentation in our Decatur office a few times before. And it's a little bit less uh, popular right now, but it was once a very popular product, and I'm still getting some people that love it, and it's called the Highland Mortgage Lock and Shop program. Actually, I don't know many companies at all that do this program, and essentially what it is you lock in your rate, and then you go shopping for a home, and you don't really see that too often. You see extended rate locks with new construction builds and things like that. What the lock and shop program is via Highland Mortgage it's a 90-day program where you essentially lock in your rate, and it's good for 90 days. And then we give you 60 days to go looking for a home. So we give you 60 days to go shopping for a home, and then we use the latter 30 days of that for the financing period. And normally we don't need 30 days at all. So we just kind of give us an extra week or so there for kind of a buffer. But I've actually used this program, I would say at least 20 times this year. Definitely when and we are still in now a rate rising environment. But so that's why this program has been super kind of popular this year. I've closed people with 4% interest rates when the market ended up being at a 5.5. I've closed people at 5% when it ended up being 6.5. So talk about a lot of kind of money that clients are saving there. And technically, even right now, if you locked in at a 6.5 or 7%, and then by the time you go into contract, if the market's showing an 8% rate, I mean, that's technically a win. It's not the interest rate that anybody wants, and you will be able to refinance no matter what at that point. But talk about being priced out of the market when you thought your interest rate was going to be at 5 or 6%, and then it ends up being at 7 or 8%. So another great product there. Just a kind of creative way to make sure your clients are staying kind of well informed and they're still eligible to buy. I've had clients that just that have gotten priced out of the market. I just saw a good question come into the chat. What if it went down? Great question. If it goes down, we will float you down. And that's a fantastic question. And we have not dealt with that too much this year because it's very rare that I've locked somebody and then the market's gotten better. However, it has happened to one client before. And what we ask is if the market gets it at least 0.25% better. So if I lock you in at 6.5% or 7%, and by the time you go under contract, if the market is actually 0.25% better, we actually will reach out to you and let you know. And what we do pretty well, what I feel like I try to do pretty well, is anytime I get a client on a lock and shop program, I actually consistently keep them updated on what's going on with the market. I'll say, hey, look, market tanked today. Glad you locked in, right? Or, hey, market's better today. We need maybe a couple more days like this, and then I can maybe float you down. We do just ask that it's a 0.25% better. There is actually zero cost to it. Another great question from Zena. I hope I'm saying that correctly there. There is zero cost. There's zero upfront deposit for it. We just kind of, I will keep the lines of communication open with the client and the agent, letting them know what's going on with the market. And I just ask that you do the same with me, hoping that you are kind of actively shopping and looking for a home. So we do reach out during the 30-day increments and say, hey, just FYI, you have 30 days left on your lock and shop to go searching for a home. Again, we take the latter 30 days for the financing period. And then, of course, if we get to a point where you need some extra days, it's always just a conversation that, I have with my capital markets team saying, hey, they're looking for homes. They haven't won any deals yet, but they're still looking. We need an extra couple of weeks. And then we kind of just determine what's the next best steps there. Another great question from Angela. What are the requirements for this product? Really, not really any requirement at all. We just ask that you utilize this product if you see your clients actively going to be under contract in 60 to 90 days. That's kind of our thing is, we don't want to just lock people if they're like, oh, well, our lease doesn't end until 10 months from now. Well, the lock and shop program probably isn't the best for you then, and you're going to clearly be in your home renting until your lease ends until for the next 6 or 7 months at the very minimum. So maybe not the best product for you there. So no real requirements though. In terms of what we ask for from a credit or income aspect, it's a very straightforward conventional program. So we just ask that you hit all the normal conventional. We do it for FHA as well. I will say this. We offer government programs. Excuse me. So we just ask that you meet those requirements as it pertains to those specific guidelines. Chris, you just asked if I can put my contact in the chat. I will actually do that right now.
Okay, guys, do you all have any questions for, and it's Krishen, not Christian.
Yes, Christian. Yes,
Krishen.
Yeah.
I was corrected on that myself last week.
No worries.
No need to apologize. I thought it was Christian too.
All good.
Anyway, he's a great loan officer. This is not a session to sell you on Highland Mortgage, but Christian has a lot of experience over the years dealing with these types of scenarios that I think you guys need to be made aware of. And the only way we can get better at what we do is to brainstorm and mastermind like we're doing right now. So, Krishen, anything else from you today that you'd like to talk about? Everybody seems to really be enjoying your.
Hi, Tom.
Yes.
Hey, Tom. How are you?
I'm good. Who is this?
Phyllis.
Oh, hi, Phyllis.
Hey, I just want to ask, Kristen, do you all do any commercial lending at all?
We do not do any commercial lending, unfortunately. We are strictly residential. We are definitely a local kind of boutique type of shop. So unfortunately, no commercial financing yet. I too would be very interested if we did. I come from a family of hotel owners and such, so I'd love to have that one day. But unfortunately, right now we do not.
Okay, thank you.
Yeah, you're welcome. And sorry, Tom, to answer your question, nothing really else for me particularly. Again, yeah, this is not by any stretch of the imagination trying to sell a Highland Mortgage or myself. I definitely want to just make you all aware of the products that are probably going to be benefiting your clients the most right now.
Absolutely. That's the purpose of this call, guys. The programs that he's gone over are the programs that I think you need to be made aware of that you may not have had experience with in the past. And they're going to become more commonplace as we move forward until interest rates sort of taper off a bit and start to become a little more normalized. But that's not happening right at this very minute.
Yeah, I would absolutely agree. I haven't gotten a standard conventional, by the book file in a little while, and think everyone is trying to get a little creative. And once buyers understand that there is an opportunity to not have to be at, deal with the ramifications of this market right now, I think it's a great piece to get creative and try and help your clients out as best they can to try and save any money they can.
Right. Nick has a question, or he has his hand raised. Hi, Nick.
Yeah, good afternoon. Nick Miles, Keller Williams, Atlanta Classic. So I used the 2-1 buy down program before. I have used that, and it's definitely a good tool, especially if you get into the higher price points. It's just probably any price point at this point. But I don't know if I was on at the very beginning, but the way we did it, well, we just asked for a certain amount in closing costs. And we used those funds that was going to be contributed by the seller to, in a sense, do the 2-1 buy down program. And the lender just calculated what the payment would be, because I don't think the numbers were exact. And just the mortgage payment and it just affected the mortgage payment, meaning they were paying less in interest. So I've done it. It does work. You definitely have to have someone that understands this program to make it work for you, or to have it work for you, but it does work. And the seller just has to cooperate to give the necessary funds, contribute to the buyer's closing costs, or I think somehow you can add it to the purchase price, and that way you can, and however it plays out, the offset, you can write it off as closing costs. Am I in the right direction? Is that correct?
Yeah, that's definitely correct, man. And great point. I hope everything worked out smoothly for you there. That's great lending for whomever you worked with. If they notice that amount of closing costs on a contract or an offer, that was great, smart, forward, proactive thinking for them to offer up the buy down program. But yes, that is correct. It does go up against your cap. So agents, please do watch that. I've had it come up where we were right at the cap, and then of course they went and did an inspection, and they wanted to get more in closing costs, and we just, unfortunately, that wasn't going to be able to work because we were already up against the cap in order to use the buy down program. But yeah, no, to answer your question, that is 100% how it works.
Yeah, and guys, this is a very important program for your sellers. When you go on a listing appointment, this is a very important program to explain to your sellers and prepare them that they may have to come up with more closing costs, so that the buyer can get a better interest rate, and they can get their home sold. So this is a tool in your toolbox for not only your buyers, but also for your sellers, right? Angela Williams, you have your hand up.
Yes. Good afternoon, everyone. Good afternoon, Tom. So
Hey.
Krishen, hey. So if I'm representing the seller, so if the seller's also going to be purchasing a property, how would this program affect their home purchase process?
Yeah. So, if you don't mind, if I just ask a couple of questions there. So they're selling and buying at the same time?
Yes.
So yeah, for sellers, it could definitely work well where, if you have to sell your home in order to use the proceeds, then, offering up some sort of incentive like closing costs incentives is definitely going to attract more buyers. I feel like, and anytime you can help a buyer out with their monthly payment or closing costs, I think that's always a really good incentive. If they get into a point where the property is just, they're not really gaining much traction, or it's a little tough to move, as long as they can qualify, we can always look at doing a bridge loan, to take out some of the proceeds so they can put the down payment on their new home. And it's always a case by case base when it comes to that type of stuff. Obviously, you want to make sure they can qualify with the worst case scenario there, with their current home currently not being sold and they're purchasing a new one. But you could theoretically use the buy down program from a seller standpoint and a buyer standpoint at the same time as well. That would be definitely something that I hadn't seen before, but that's 100% doable. Hope that
Okay,
answers
so
your
they would have
question.
to, okay, so basically they would have to be able to qualify for both homes. Is that correct?
Well, if
Because
as
the
long as
price- Go
yeah,
ahead, I'm
if the home is not going to be sold prior to them closing on the new home, then yes, they would have to qualify for both homes being hit against them. But if it closes before or even on the same day as a new home, then we can actually we don't have to hit them for that current housing payment.
Okay. Right, thank you.
Yeah, you're welcome.
Hey, Krishen, it's Josh.
Hey, Josh, how are you, man?
Hey, it's good. How are you?
Good to see you, or good to hear you.
Thanks, man. I had a quick question. If someone uses the 2-1 buy down, or like maybe thinking to get the seller to pay for it, and is that contribute towards the the total seller paid closing costs? And I apologize if you answered this already. Like if they're paying 5% down and seller can't pay more than 3% of the seller buyer's closing cost, does that part of that 3% total when they do the 2-1 buy down?
It does, yeah, it does. It definitely does. And yeah, no, that was one of the main things that I kind of mentioned is you want to watch those caps, you want to watch those limits. It does go up against that. So definitely something to kind of look out for. I've only had one issue where it came up where they used all the seller funds for the buy down program, but then they did an inspection and they wanted to get additional closing costs for just various things around the house that came up. And yeah, unfortunately, we weren't able to work it that way. So definitely something to look out for. And I'll always say just kind of consult with your lender, and make sure the lines of communication open there, and we can always advise as best we can.
All right,
Can
thanks,
I
Krishen.
interrupt for 1 second? Very good point. I want you guys to understand what he just said, and that way you can communicate this with your buyers and also with your sellers. There's a limit, okay? So if you use your limit on the buy down and they want to ask for money for repairs, they may not be able to do that. That's a very important point I want you all to understand. So that doesn't mean that the seller can't make the repairs, but they're not going to be able to get any more money than what is allowed on that buy down. So please make sure you understand that. All right. Sorry for the interruption. Krishen, go ahead.
No, yeah, no, that's just a good point, and something to definitely look out for. It's I wouldn't say I got bit by it, but I've dealt with that before. So I have every time I have a talk with an agent about this product, that I do ask that they keep that in their minds. And normally, if we have a 6% limit, chances are we're not going to go up against that. We're not going to hit 6% of a purchase price amount. Normally, if I see an application come by and it's for a 3 to 5% down payment, I definitely will mention it. So it's just good to kind of watch those caps.
We have two questions. One, Tammy, it looks like you've got your hand raised. Do you have a question?
Yes. Hi, Krishen. I wanted to ask about the bridge loan and comparing it in terms and rate with the HELOC. What are the differences? And because you could use them both for the same purpose, right?
Yeah. So no, great question. So a bridge loan is essentially kind of like a HELOC. It's just a 90-day lock. It's just a 90-day term. So the rate is variable though. So I definitely want to make everyone aware of that. So right now with the Fed funds rate, when you hear the Fed going up on their Fed funds rate, that directly affects HELOCs or any sort of line of credit. It doesn't always impact mortgage rates. This year, we've obviously seen that it has, with an addition to stuff just happening around the world and the economy. But that is a variable rate. It's the only difference is it's a 90-day period instead of a HELOC being pretty much open-ended. So the bridge loan does, we do fully make the clients aware that, hey, this is a 90-day bridge. We do expect that your home is listed and sold during that 90-day turn time. But it's a great way to get your proceeds out of your current home, go ahead and move into your new home. For people that have families and kids and things like that, it's a good way to go ahead and move into your new home, and then you can sell your current home kind of with a lot more time on your hands.
Okay, and Joel, you've got your hand raised. Joel Athy.
I got a question. As far as the 2-1 buy down, on the say if the house is about 400,000, about how much would the 2-1 buy down be? About how much would it cost the client?
Yeah, that's a great question. Actually, you know what? I can actually manipulate a spreadsheet that I sent to a client of mine and just alter it here and get you actually a much firmer answer. So if we were at did you say 400,000?
Yes.
So if we were at a 400,000, and then what would you say that they were putting 10% down, 5% down?
Let's say 5%.
Okay. If I was at that, if we were looking at a 2-1 buy down and their loan amount was 380, you'd be looking at right at about $8,500 for the cost of this program. Now, now we can always alter that, and I just want to make sure I check my math here. Yeah, okay, 380. So yeah, you'd be right at about $8,500 for the cost of the buy down program. If you were, let's just say, make sure that you would be granted, right? 3% of 400,000 is going to be $12,000, which is going to be your cap for your seller paid concessions. You would need to use 8,500 of that, or around about that much, give or take a few dollars here or there, for the use of this program. So one thing that you could do in a certain situation, let's just say it was 400,000, you could say, hey sellers, what would you think about putting it up to 410, and then giving us $10,000 in seller paid closing costs? You're still under your cap, but you're able to use the 8,500 for the cost of this program, and then the rest can just be used towards your actual closing cost. So that way, you're able to save your clients a whole bunch of money during those first 2 years. And another cool thing about this product is we make the clients aware that, hey, at the end of year number 1, your payment's going to go up a little bit, right? Because you're going to be 2 percentage points lower on your first year and 1 percentage point lower on your second year. So we do make them aware, hey, your payment's going to go up a little bit, just FYI. And then on the third year, it's going to go up to, it's the note rate that you actually locked in at. And the cool thing about that is a lot of people that do this product, they understand that. And, it's almost like you're planning for the future, right? If you know your payment's going to go up, it's best that you probably plan for that, knowing it's going to happen. So, it's kind of like, hey, I'm getting into the home, but I know my payment's going to go up a little bit. I can plan for it. And once you are able to refinance, whether that's 18 to 24 months from now, I mean, think about the amount of equity that you've kind of gotten into the home now. And not to mention, your home is probably appreciated a fair amount as well.
Hey, Joe, Tom, if you don't mind, I just wanted to say something because I did use the program before. But
Yeah,
Joe,
absolutely.
we asked for the full 3%. I think on the $640,000 home purchase, we asked for the full 3%, and the seller honored that. So So only a portion of that was able to be used towards the 2-1 buy down, because however they factored out what the adjustment would be over the next 2 years, it was factored out. And then the remainder of about $5,000 was used towards the buyer's closing costs. So it's a sweet deal for the buyer. The seller, and we did up the price about $10,000 to make all the numbers work. So it worked out. Everybody's happy. And it's definitely a cool product if you have a client that's good for that particular scenario.
Yeah, great story, man. That's
Okay,
awesome.
we have several hands being raised. Chris Roberts, and then
Yeah.
Amy will get you next.
Okay. Hello, Chris. This is Chris Roberts from Keller Williams Atlanta Classic. And I just want clarity on 2 questions that I have. The first question is, did I understand you correctly with the 2-1 buy down on that 3rd year, the interest rate would not rise more than what was locked in initially for?
That's correct. Yeah, no, great question. So, so the first year, let's just say you lock in at 7%. The first year it's at 5%. The second year it's at 6%. The remainder of the 28 years that is on that 30-year mortgage would be at 7%, assuming you don't refinance at all.
Oh, okay. And my second question is, if you want to raise the price of the home for the 2-1 buy down or any of those programs, is it contingent upon the appraising for that extra?
Yeah, no, another great
Okay.
question. So that's correct. Yeah, we have not, me nor anyone at my company yet has gone through an issue where the property has not appraised. Most appraisers, and just to kind of let you know a little bit more information there, is we have in-house appraisers. They don't work for Highland Mortgage, but they're completely on our panel. And we've actually worked with them. I've worked with them for good 7 or 8 years. Some of them have been around working with our CEOs and director of operations through various companies for the past 15 to 20 years. So there's a reason why they're on our panel. They're fantastic appraisers that get everything done on time. And they also aren't going to nickel and dime you on if they see a purchase price is at 400, they're not going to do an appraisal. At least so far they haven't, and to my knowledge, not going to do an appraisal at 396 or something like that. They're just going to put it after the purchase price point. And assuming that they'll have to provide some evidence and some comparatives around there, but I have not dealt with that before. It is derived around the purchase price, the appraised value. I have seen one agent put that verbiage into their contract saying if it doesn't appraise, we come back to the drawing board, and it's not just solely on the buyer or just solely on the seller to come to the table. So always something that's, negotiable between all parties. But to answer your question, it does revolve around the appraised value.
Okay, thank you.
Yeah, you're welcome.
Okay, and Amy, you have a question?
Yes, can you explain? I didn't understand why you were giving the example of the home under contract for 400,000 and you said you'll go up to 10, and then what is the purpose of raising the price?
Yeah. So the purpose of raising the price is so that you can go to the seller and ask for some seller concessions. So hypothetically, right? I believe it was a hypothetical 400,000 that a gentleman asked on this call. So it was 400,000, putting 5% down. So your loan amount's 380. It was going to cost right about $8,500 to do the 2-1 buy down program for this. And so what you can do hypothetically in how this product really works is you can go back to the sellers and say, hey, instead of 400,000, put it up to 410. And in turn, give us $10,000 back in seller pay closing costs. The seller nets the same. The agents are happy because you got a deal in the works, and the buyer's happy because now they are able to move into a home with a much lesser monthly payment for the first 24 months. So that's kind of how it works. Again, all of the cost of this program cannot be paid for by the buyer. It has to be paid for by the seller. So that's why you have to ask for seller paid concessions so that you can make this program work.
Okay. Thanks.
Yeah.
Okay, guys, we've got about 15 minutes left. Does anybody have any other questions for Krishen that he might be able to assist with while we have him on the call today? Yes, Nick?
Yeah, real quick. So you did mention that you could possibly do the other option, which is becoming more popular, lock the rate prior to shopping, right? And you mentioned the 90-day lock, right? Is that accurate? Because, you know, I know depending on how the length of your lock, whether it's 30, 45, or 90 days, it costs, there's a different cost associated with the length of your lock. So if you pre-lock before you start searching, are you locked at a 90-day rate? I mean, I guess 90-day cost for that rate. That's my question.
Yeah. No, that's a great question. Yes, you are locked. You actually are locked at we actually lock clients at a 60-day lock on those 90-day. So it'll be slightly worse or cost slightly more if you were doing a 90-day lock rather than a standard 30-day lock. The difference is, right, in the main kind of almost attraction towards this product is that you are almost protecting yourself when we are in a rate rising environment. So I have not had, with the exception of one client, I have not had any lock and shop deals go through, and once they go under contract, the market is better. I just haven't had that. And actually, I've had more clients be totally way off in terms of it benefiting them rather than I've not even had many clients where it's just been kind of even. They've all benefited from locking early because the market is just consistently kind of selling off. And so but to your point, that is correct. We will, the 90-day lock is priced a little bit more expensive than a standard 30-day lock would be, just solely due to the risk involved in a 90-day turn time.
Any other questions for Krishen, you guys? Okay, Krishen, great presentation, great information. I hope all you guys got something good out of this. I know that I certainly did. And we really appreciate your time today. And you all have his contact number in the chat. If you need to reach out to him, please do so. And is there any other questions that you have for me or anything else that we need to talk about before we dismiss today? Okay. All right. Well, thank you all for joining us today. I hope you got something out of this. I thought it was excellent, and we appreciate you being here, and we'll see you in 2 weeks for another broker chat.